Está con nosotros Fabio Angelini, Senior Investment Specialist, European Fixed Income at Nordea Asset Management. Welcome, good morning, Fabio.
Thank you very much. Good morning, everyone.
We could see during the year a lot of events from geopolitical central banks, and everyone is checking different things for markets. Where do you fixed income investors stand, and what may lay ahead?
Yeah, that's the $1 million question, right? So I think things seem to be very fragmented, especially after the election turnaround in the US. I think there are trends that are diverging. For example, if you compare US to Europe, the situation looks quite different when it comes to inflation. One seems to go down in Europe, the other one is a little bit more certain in the US. Growth is very different. But I think if you look at Europe specifically, there is one thing that is definitely somewhat clear today. And what I mean is that if you ask me the same question even just a few months ago, I would probably spend most of the answer on inflation, actually. But in Europe, that's, it's not to call it a done deal, but it's definitely a problem that has came down to a much smaller size recently. We have seen inflation printing at around 2% or even just below in the last couple of months. There are good reasons to believe inflation will stay at this level in Europe, unless you are particularly positive on growth in Europe, which might be not straightforward, not as in the US, for example. So I think the point here is, if you look at European fixed income from above, you would see a market that is, when the market puts a price on inflation, the market is expecting inflation to stay just below 2%, actually, in the coming year. But it's expecting the ECB to definitely cut interest rates, but cut them down to 2%. So looking into 1 year from now, the market still sees inflation a little bit lower than where the ECB is actually cutting rates. And this, I'm of course simplifying a bit, but it's not too bad for fixed income assets, right? Because it means that duration valuations are by no means particularly stretched. The terminal level of interest rates is comfortable enough for the ECB to actually end up doing a little bit more, so cutting rates a little bit more than what is priced in already, which is typically an uplift price potential for duration and high credit quality. Now, this is one side of the equation. The other side is clearly you build on top of the risk-free of the duration, you can take the credit risk side. And that is where most people have focused in the last few months. So they've stopped or diminished their focus on inflation, and they started to think about something else. And that something else has been, to a large extent, recession, slowdown, those kind of things. Now, if you look at the latest set of macroeconomic indicators for Europe, then what you see is actually GDP growth is upticking, not very large growth, 0, something, but it is upticking. Unemployment rate is actually pretty low in Europe, if you look at numbers, with some exceptions, of course, country to country, but generally low on average. Demand for mortgages seems to be timidly back. That's what banks are reporting to the ECB in the latest bank lending survey. So normally, these are things that do not happen when a major recession is about to blow a hit to the economy. So what I'm trying to say is that also credit might look interesting. And to wrap it up, what I mean is that I think there are reasons to be somewhat excited on fixed income in Europe, very much across the spectrum, from duration down to credit. I think there are a lot of interesting things. You refer to opportunities. I think that's an interesting moment to look at fixed income assets in Europe.
And there are an important bet in this moment for fixed income, that is in the United States, Treasury, 10 years. Do you think that could achieve 5% again?
I think so. Generally, inflation tends to be linked to growth, right? So the higher the growth, the higher inflation, typically. So it is really a question about growth. And it is true that US economy has been more resilient, say, than European economy, and also that it seems to have better chances to keep growing faster than Europe, simply because we've seen the Trump agenda, for example, a lot of measures on fiscal spending that are pro-growth and things like this. Not the same in Europe. We know that, for example, German government actually had a crisis because spending was not agreed in the coalition. So to answer your question, I think actually interest rates in the US, or let's say the Fed still has room to actually cut interest rates and then keep the short end of the curve at least under control and perhaps on a lower rate trajectory. The longer end, as you mentioned, the 10-year, I think there is perhaps a little bit of a weaker spot, meaning there could be reasons to see higher levels. Nobody has the crystal ball, so 4, 4.5, 5, 5.5, very difficult to tell. So my best answer would be, I'm not really sure, but definitely the longer end of the curve in the US could lift up, actually, perhaps towards the 5%, maybe a little bit lower than that. It depends where we set the expectation for growth eventually. So, yeah.
How do you think is the best way to invest in high yield and investment grade in this current environment?
Yeah, I think here everybody would have a little bit of a different opinion on whether high credit quality looks better than credit and so on and so forth. And that again boils down to whether you expect a little bit more of a slowdown or a little bit more of a growth uplift. But one thing on which everyone, I guess, would agree, in Europe at least, probably also in the US, is that in this process of inflation moderating and perhaps having some oscillations, but definitely coming down from the very high level of 2022, the interest rate curve, the yield curve, it's also already no longer inverted in many terms. It's still a little bit inverted in the very short end, but it is re-steepening. And typically, when this happens, it can be into a positive risk-on environment, or of course, a little bit of a more risk-off environment. In both these two cases, the interesting thing is that if you look at the very middle range of ratings, say where investment grade is turning into a yield and vice versa, so BBB to BB, those are bonds that historically, in this kind of context of re-steepening of the curve, have done very well in both of these two scenarios. So it is not easy for all investors to put what you would call something like a cross-credit type of strategy that goes in between high yield and investment grade into a specific bucket, because it is going across those two buckets. But we would probably argue that's a very interesting point to look at now, because the combination of these two variables, the risk-free duration and a little bit of credit risk, but not too much, so what you find in the BBs, tends to do very well, or has done very well historically in this kind of environment. So that could be one idea to actually look at fixed income market, knowing that it's a strategy typically is never the first and never the last, because you're balancing out things. So it's about being balanced rather than trying to be number one on the podium, if that makes sense. But it's an interesting spot, we would say.
What about the European financial market?
Yeah, so financials specifically, it's good stuff, if I can put it like that, because I think if you look at, again, in the end it's about credit quality, right? And how much yield you get per unit of credit risk, if you wish. Now, we know ratings are not a perfect measure of credit risk. There is some dispersion in the universe, but I think the overwhelming majority of rating agencies today agree that financials, banks, and perhaps even more insurance, they are among the most solid issuers. So, it is the kind of players that basically won the lottery in the last few years, because they largely benefited from interest rate going up, and they come from many, many years of de-risking. So basically they spent the last 10, 15 years reducing the risk, and now they start to make a lot of money. So this sounds good from a creditor's perspective. Now, the point here is, regardless of the fact that the credit quality is pretty high and better than many other sectors, also the yield, it's very competitive relative to other sectors. So one thing you could do, or one thing everybody tries to do, I guess, is you look at the yield offered by a bunch of companies, say grouping them by sector, for example, and then you will have your best expectation on what is the risk embedded in that sector because of the business they run. So there is a certain default risk linked to running a bank as opposed to running an insurance, as opposed to running a cinema operator as a supermarket. Now, the risk of default for banks and insurance companies today, I think it's arguably much lower than many other sectors. And still the yield is really decent. Once you adjust yield for default likelihood, we would argue you get to a situation where insurance and banks stands out as a very strong yield relative to credit quality. And this has been the case essentially since Credit Suisse went belly up a little bit more than a year ago. People demand generally a higher compensation for being invested into financials. We're not overly positive on the whole financial spectrum. We are a little bit more careful on what you would call CoCo bonds, additional tier ones. They've done very well recently. I think perhaps they trade a little bit, tight in valuation, so easy to surprise the market on a negative side when valuations are so tight on that part of financial debt. But otherwise, your traditional subordinated tier 2 bond, we would argue that looks pretty decent in terms of value you get per risk units.
Do you see the European subordinates as an interesting investment at the moment?
Definitely, yes. So subordinated bonds, as I was alluding to, it's a very segmented and also broad, if you want, complex asset class. So there are, for example, say tier 2 bonds, without going into too much details, but there is basically a bond that has a little bit more risk of default. It can be bailed in, but typically it is called back by the bank or generally goes to a maturity event, either a call or a maturity, because for many reasons it is not efficient at all for banks to keep those instruments on the market after their first call date. So that makes it somewhat of a more plain vanilla instrument. On the other side of the subordinated spectrum, you have hybrid-like securities like additional tier 1 and CoCos, and those are in practice perpetual instruments. So they can extend to infinity, to perpetuity, and also stop paying a coupon. So potentially you're buying an instrument that never matures and never pays you anything, which typically does not have a lot of value. Now, for this type of instrument, we don't like the fact that today they trade as if they would very likely be called sooner than later. So intuitively, you don't get a lot of compensation for buying a perpetual instrument if it's priced as if it would be out of the market in 4 years. So we are a little bit more mindful on that. But on the subordinated tier 2, those are the ones I referred to before. The yield is very decent, the risk is very reasonable. It's a very good trade-off between risk and potential return. So yes, we like those.
Thank you very much, Fabio Angelini, Senior Investment Specialist, European Fixed Income at Nordea Asset Management. Good day, good business.
Thank you very much, and thank you for having me.
Thank you for having this time with us. 10